And so I think that there's a premium that has to be paid when you take on more risk, whether that risk is in the form of location, the form of vintage, older properties have more risk, and then demographics. If the rent to income ratio is 35% instead of 15%, there's more risk to that transaction. So I think of speculation when those risks are not understood very well and people are kind of doing things for fees.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Eric Barvin is the founder, chairman, and CEO of Barvin. Eric is responsible for the strategic planning and growth of the company and maintains oversight of all aspects of Barvin. Eric, welcome to the show.
Thank you, Sam. I'm excited to be here with you today.
Hey, man, the pleasure's mine. I'm so glad to be with you as well. There are 3 questions, Eric, I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Absolutely. I started in after college working as a mortgage banking analyst for a very short period of time from 2008 to 2009. Company went bankrupt, couldn't get a job, I got laid off, and decided to start my own business investing in multifamily real estate, and I've been doing it ever since.
A mortgage banking analyst is not the job for longevity, I wouldn't think, in 2008.
No. It was commercial mortgages, so it was multifamily, but still, it was a tough time.
That's interesting. Is that what turned you on to the multifamily investment opportunity, or how did you pick multifamily from that?
So a few reasons. One is I had this kind of knowledge on how to underwrite multifamily and just how the process worked and valuation. And more importantly, I didn't have any money. And so the beauty of multifamily is that you can create value when there's cash flow. And so, multifamily, you can lease it every day. You can rent apartments out. Whereas on commercial, retail, industrial, office, there's high dollar brokers that are involved and high dollar TIs that are involved. And I just didn't have the capital to go and, sit on vacant real estate and wait for a broker to bring me a tenant or for me to find a tenant and then spend the money. So I needed money day one, and multifamily was the only thing that really worked.
That's normally a disqualifier for people when they're like, "Oh, hey, by the way," I mean that's the average investor or the average wannabe investor's kind of excuse is, "I don't have money.
Yeah,
I can't get started." How did you solve that problem?
So I was fortunate. So starting in 2009, I was fortunate with good timing. The first property I ever acquired was a 158 unit property in Baytown, Texas, for $1.2 million, about $7,000 a unit. And I had my grandparents, who were very supportive of all their grandchildren, gave me a $100,000 loan, said they would give me a $100,000 loan, and then gave me a $100,000 loan for the first project I did.
Wow.
And so that turned into my co-investment. And the total equity raise was $500,000. I raised $400,000 from friends' parents. And I got a loan from a friend who worked at a local bank, who could write up to $1 million loan without loan committee. So he gave me a $950,000 loan, and I raised $500,000, and we bought it and renovated the property, and the rest is history. Yeah.
You got a. What'd you say he could write $1 million loan without loan committee? In 2009, you got that pulled.
2010.
Even
yeah.
No, I mean lending was tight, man. It was tight then.
It was tight, yeah. And it was funny because I actually had all these lenders. When I started on my own, I was trying to build relationships, and before I had any properties, I was still preparing for the moment when I would have a property. And I was talking to lenders, and they all said that they would finance me whenever I found something. They liked me a lot. And when I actually had this deal, none of them would do it. And my friend, who was a year younger than me, you can't tell in the video, but I'm very tall, played basketball in college, and he played basketball with me. And he said, I can get you a loan. And I was like, there's no way this guy's going to be able to get me a loan. He's a junior guy. Turns out he was the only guy that could get me a loan.
I mean, what? I'm just, again, I know this was 2009, bad with math. So 13 years ago, yeah, that's right. 13 years ago. $7,000 a door. It just sounds like a screaming deal. Was there just hair all over the deal, or was it just that was the time, that was the price that the market would bear?
There's hair. It was a foreclosure. It was 50% occupied, a lot of down units. But it was the price that the market would bear. No one was looking to buy multifamily at that time. No one was being able to finance multifamily at that time. And Wells Fargo, their loan amount was $3.6 million. They sold it to me for 1.2. And I felt like for them, they're just getting one thing off their books, and they're going to worry about 60, 70, $80 million loans, not $3 million loans. And so what's the difference?
Right. Yeah.
Right, at the right time. Yeah. But no, from 2010 to 2013, the vast majority of what we bought was somewhere between, maybe 7 was the lowest, but somewhere between 7 and 15,000 a door.
Right. Yeah. And that the times have certainly changed.
Yes.
At what point do you feel like, and again, you're still in multifamily today, but or is there a point when we're overbought, or when people are now just wildly speculating? Have we hit that stage yet?
I think we're actually a little past that stage on the speculation side. I think there's been a lot of speculation, specifically in B and C apartments. We got out of the Class C business a little over a year ago, maybe more than that. Disposed of all of those older properties. We still have some Class B apartment communities that we're actually in the process of selling right now. But since 2018, all we've acquired is Class A communities, or all we developed is Class A communities. Which there's speculation in that space as well. But the multifamily, in my mind, has a strong correlation to the creditworthiness of the renter demographics.
Right.
And so I think that there's a premium that has to be paid when you take on more risk, whether that risk is in the form of location, the form of vintage. Older properties have more risk, and then demographics. If the rent to income ratio is 35% instead of 15%, there's more risk to that transaction. So I think of speculation when those risks are not understood very well, and people are kind of doing things for fees. And so I think we've already passed that. And I think that with interest rates rising, there's a realization of, oh my gosh, what's my exit? How do I exit? And I think that, assuming that, it'll be interesting to see how it plays out.
It really will. I want to hear maybe in a minute how you guys are finding opportunity in Class A. But I guess before we get there, do you feel like there's going to come a time in your buy box where B and C will re-enter that picture?
I think we're always open to buying well-located B and C for the idea we can eventually tear it down. Our filter is really location based, and so if a B or C property came up in a location we wanted to buy in, or with an older property with a strong demographic, I think we'd be open to it. We've toyed with the idea, if there becomes, not to say that the world's going to go back to 2010, but if there becomes significant distress in the B and C space, do we go back in? And I think the general consensus here has been, we don't go back in. We stick to what we know. We stick to what we're good at. And our company, our competency is definitely more in the Class A space today than it is in the Class B and C space.
Yeah, that's the question is, if there does become distress in that, and prices again, not that I ever expect them to get back to the $7,000 a door range, but if they do, drop precipitously, is that where someone like yourself says, oh, you know what, maybe we'll get back in? But it sounds like the answer is no, just because you have your buy box inside of Class A, the asset you're buying, that's also what you're developing. Tell me your thought process behind that.
So if you looked at 2010, right, and I bought this property for $7,000 a door, and at the same time, someone bought a Class A property that was distressed for $120,000 a door. Okay, because that's kind of what they sold for 10 years ago.
Okay.
Well, 10 years later, the one that was $120,000 a door became $220,000 a door, and the one that was 7 became 50. And not to say that there's maybe a better return on the $7,000 a door one, but your life, your stress, the amount of capital you had to put in the project after the fact, the demographic you're renting to is a lot more a lot more. It's a lot easier to operate that kind of property, and I think you still do experience quite a bit of appreciation in the space. Maybe not the same as but there's a trade-off always, and like I said, the demographics really drive where there's risk in a multifamily investment, in my opinion.
For sure. Yeah. It sounds like the risk adjusted return plus the amount of time that maybe you have to put into some of those more vintage assets for you guys just doesn't make sense anymore.
Yeah, correct.
That's all. Okay. Fantastic. Correct. I love that. Tell me about Class A. What is the opportunity, and then what is the risk you guys currently see in the Class A assets you're both buying and then also building?
So I think just on the opportunity, what we like about Class A is that the low rent to income ratios, meaning that someone who spends, 10% of their income on rent has the potential to spend more on rent. And as we look and we evaluate what rising interest rates are going to do or are doing to the single family market and how expensive it's becoming to get a mortgage on a single family home, we think that translates into more people staying renters and paying more rent and rental rates rising. And so we like that space because we feel like those individuals, a $3,200 two-bedroom apartment could go to $4,200, but because they can afford it. Right. And that's why we like the space. The things that obviously we're heavily aware of are floating rate debt. We acquired 3 properties in December with floating rate debt, and those properties now, even though we have caps, but even though we have caps, the debt service increased substantially, and now we have to escrow for buying new caps, and there's a lot of fluctuations. And so anything with a maturity or a floating rate with a cap expiring soon was something we're very aware of. Fortunately, we don't have much with maturities in the next few years. And then on the acquisition side, we're not afraid of negative leverage. I think a lot of people are afraid of negative leverage, meaning that the cap rate is lower than the interest rate. We're very focused on rental rate growth. And so if we feel like the rental rate growth program is like right in our lap and like very clear that we can achieve those results, we're okay with negative leverage as long as we can get to neutral, within 12 to 18 months. Development is a little bit more difficult in some ways because of the rising interest rate expense and rising construction costs. But at the same time, you're kind of pushing your stability out 5 years, your stabilization date out 5 years. And so there's more time to get things wrong, if that makes sense, as opposed to on an acquisition where, every quarter, yourself, your investors, your team, hey, did you meet your pro forma? Did you meet your pro forma? So development's not a bad place to be, I think, right now, if you have the right capital for it.
Right. No, absolutely. I want to go back to the negative leverage comment where you said that you're not opposed to that. How are you underwriting an asset with negative leverage outside of, say, just going by strict comps, saying, okay, everybody around me is charging XYZ, so we can actually get there if we do, ABC. How are you underwriting those such that it makes sense to go into a deal with negative leverage?
Well, so I think there's obviously a couple components. The first component is your price, right? So I think if you look at the pool of communities and you say, well, everyone's sold for 250 unit, I'm paying 200. Well, I think that there's a case to be made of, okay, well, maybe it's not making sense today, but I don't think interest rates are going to be high forever, and we're getting in at a higher cap rate than they got in at, and a better basis. And so I think there's some logic to that. What we look at really is what you would call probably like loss to lease or lease trade out rates. So we're looking at that and trying to forecast, one, how can we improve based on what they're already doing? But also, like we're looking at a property now, and it's the only property that the company owns in Texas, and they manage this themselves. And so it's the only property they manage in Texas and they own in Texas. So they're not operating it to its maximum potential. So it's hard to say, well, yes, we're just going to take their cap rate and plug it in or whatever, because you have to kind of understand the market and understand where it's going and where it could go. obviously you don't want to pay too much for that because you want to still get the reward of that. But you want to pay, as much as you have to pay and benefit from the rest.
When it comes to your development projects, are you guys currently putting more projects in the ground today as we speak? Are you guys just finishing out what you already have in the pipeline?
So we're going to start another project, a big mixed use project, in about 2 months. It's something we've been working on for years now, so it is moving forward. And then we're also consistently looking for sites, mostly at this time suburban sites that make a little more sense from an underwriting perspective, because you can build 3-4 story wood frame product as opposed to podium product or mid-rise product. The wood has come down, and I think wood's going to come down even further. But concrete and steel have not come down, and so high density is very difficult to pencil right now.
That's really insightful. Yeah, wood. I haven't checked the lumber futures here recently, but certainly, it was probably a month ago. I looked at it, and it was pretty astounding how far back down wood products have come.
Yeah, absolutely. I think that we just approved an IC meeting this development project to move forward, and in the model previously it was at 750, and now it's at 500 or 550, and so they updated that, which allowed us to absorb some of the other increases in construction costs.
Right. Yeah, I'm sure it's not a profit center anywhere, but it's just let me absorb that from what else is going to cost us more than we anticipated. That's exactly. About the way that absolutely goes. Do you guys use the markets at all to hedge on these giant construction projects that a move in the market one way or another can really just eat into things? I mean, is that if that's not a tool you guys use, how do you guys protect against fluctuating materials prices?
Well, so on materials, we actually buy all the materials. We don't build the project ourselves. So we get a GMP from the contractor, and at the time they acquire the materials. I think they take usually 6 months. I don't know the exact. I have a in-house construction team and development team, and they would know more about how that works. But we're not essentially making bets on lumber or making bets on concrete. We basically agree to the GMP. We have our own contingencies. They have a contingency, and then we move forward with it.
Let's talk about team for a minute. It's starting off from you as buying a single 158 unit on your own, $7,000 a door, to now building a multi-year mixed use project you guys have been building or designing and having the works, to now finally getting that developed. You got development things going on. You guys are still active buyers in the Class A market. You got a lot of people, I would imagine, that you've onboarded and brought onto your team. If you were to give advice to anybody that's starting out and or just now scaling their business as it pertains to team, what is one thing you would tell them, either that you wish you knew back in 2009, or maybe even something that you said, hey, this is something I've done really well?
This could take over the whole podcast. So I think that the biggest lesson of myself is to understand where my strengths are, and to hire around my weaknesses, and eventually to also hire for my strengths. So, I'm fortunate. I do have a very robust team today. I've also made incredible investments into my company. So hiring people, physical investments of people, but also technology investments, office investment. There's lots of things that I've come out of pocket for, much more than just the fee income that we get, because my obligation is to our partners and to our investors and to myself to make sure that we are great stewards of capital. And because we're operators, we need to be great operators. And so I would say, don't be hesitant to invest in yourself. It's so funny when I meet entrepreneurs and they say, oh, I want to invest in your deal. And I'm like, invest in your own company. Get your company to be self-sustainable. Hire a COO, hire a CFO, hire these expert level people. And then when you have extra money in the future, then you can invest. But don't take money that would go into growing your company and invest in my projects, because you need to invest in yourself first and foremost. And so, that's definitely been my approach. We use a lot of technology. We use predictive index. We have lots of accountability tools that we do with one-on-ones and quarterly reviews and things like that. I don't know if that's getting too in the weeds, but there's lots you can learn about recruiting, retaining the best and the brightest. And I think that's one of our goals as a company, is to have a company that's home to some of the best people in our industry.
Do you feel like that is a skill set that you have honed over the last 13 years, or is that something, and it's okay if you did, but is that something as you came into this business, you really feel like you had a good grasp on team and people, I guess, not management, that's not the right word, but maybe even the right way to put that is kind of leader creation. Because it sounds like that's what you've really focused on, is investing in yourself and those around you to create leaders inside of your company. Is that a skill set you already came into this with, or is that something you've built and kind of learned on your own as you've built this company?
It's definitely a learned skill. It's not something that was not innately in me. I didn't work in corporate America for more than like 7 or 8 months, so I didn't really have the training, I would say, to be a good manager of anyone. But I have worked very hard to try to not forget things that I tell people. Like, I have a little process where I write them down, and when I meet with them next time, I say, "Hey, oh yeah, what's going on with so and so?" And I've also worked very hard I'm not a micromanager, so I'm not someone that's in people's business, or I don't want to tell you how to do something. So in our company, I've really hired experts. If you go on our website, you see who's here. I mean, people with 10, 20, 30 years of experience. So it's not a situation where I think that I know everything. I think that, and oftentimes I know the least, and I'm kind of the ringmaster that's making the show go on, but I don't know how to do any of the tricks myself. And so that's probably just a humbleness, I think, I think I had to have to bring on these people.
Absolutely. And I think it's always intimidating, I think, in that position where it's like, wait, I'm bringing you on and you're way better than me at this, which is what you want. I mean, every good business owner wants to hire people around them that are way smarter than they are. But it's like, oh, wait, you're better at this. I remember I was in my early 20s and I got thrown into a business and I was hiring guys twice my age. And I was like, oh, wait, this is really, really outside. It took me a minute to get used to that. It was like, okay, this is a lot. And I've got to bring on people that know what they're doing, and I don't. And I look forward, Eric, if you find any of those resources, certainly we'll include those there in the show notes. I know that's something, it's kind of a hot topic for me right now, is on the leadership development front. It's something that I'm aggregating as many resources as I can for our listeners and for myself that develop those skill sets in us, because like you said, you had 7 months in corporate America and then you're off to the races on your own. So that's a great place to start. I love what you have built. It's pretty impressive here in the last 13 years to do everything that you have done up to this point, and certainly enjoy what you sharing with us, your insights, and coming on the show today. This was loads of fun. Eric, if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
So I'd say the best thing, if you want to learn more about our investments, is just to go on the website. It's www.barvin.com. So we have a link on there. That's simple. It's a contact form. If you put your information in, we can start building the relationship and have someone from our team reach out to you. Kate Kelm is our head of investor relations. She's also on the website. The big thing with our business model is that there's no cost to see our deal flow. So basically, if you want more deal flow, if you want to see what other people are doing, just go on the website, sign up, and we'll send opportunities on the horizon as they come. I'm usually the largest investor in each project, and so that gives people a lot of comfort, typically. And so anyway, we're all about alignment and long term. And so if anyone's interested, you'll definitely reach out.
Fantastic. That's barvin.com, BARVIN.com. Eric, thank you again for coming on the show today. I certainly appreciate it.
Thank you, Sam. It's been great.